Welcome to the Daily Update, where I'll go over the action in the market for Wednesday, June 7th, and then we'll see how things look for Thursday, June 8th. We had another slight down day. The market is still really having a difficult time with the 4,300 level. We went right up to 4,299. That was the high for the day, and then we started coming back down. That's part of the negative side for right now. The good news is that the broad market seems to be showing a lot of improvement, and I'll go through that when I show you the charts. On the negative side, we're seeing growth declining a little bit when compared to value. We'll keep an eye on that to see if the market is shifting overall, as the big stocks were really pushing everything higher, and we didn't see broad participation in that move up. Maybe now the broad market is improving, and when the big stocks get done being overbought on a short-term basis, that might help us to push higher. As we always do, we'll evaluate things every day to see if we end up falling and then switching back to a more negative stance. But for right now, it's still maintaining this positive posture. Some notes before I get started. I do have a new supplemental video that I posted a few days ago. It has to do with protection or hedging either a stock or your portfolio. I do have a PDF that you can download to follow along with the charts and slides. I have a private Facebook group that you're welcome to join. I do have a new poll that has been posted for this week. And if I can't be found on YouTube, please jump over to Rumble. I do have a channel on there as well. Let's go back and talk about what happened. Right at the open, we did have a higher open, and prices climbed above R1 at 42.94. Unfortunately, that set the high for the day. Prices then fell back to the unchanged level and found support for a little while at the daily pivot, which was at 42.78. As the day went on, we fell down below the daily pivot all the way down to S1 at 42.69, and then we chopped sideways for pretty much the rest of the day, closing just at about S1. We were down 0.38%, but this is interesting, on above average volume. Maybe that's some of the volume coming into the broader market. Our technicals were still positive, but we're short-term overbought. We haven't worked off the overbought condition in the short term. We're almost worked off in the intermediate term, so things are still positive overall, especially if we're seeing more participation by a broader range of stocks. The market is still now really fixated on inflation and interest rates, and what is the Fed going to do next week? We didn't really get any new banking information, but Janet Yellen gave an interview on CNBC and pretty much said, well, we might need to see some more consolidation, meaning that big banks may go out and buy smaller banks to help avoid some kind of a problem. What are some comments that we can make? The broader market continues to show improvement. We want to see follow through with this. 4,300 is still providing overhead resistance. Small caps and mid caps, they really outperformed the bigger stocks, but growth did underperform, and I'll show you the charts to back that up. Communication, tech, and discretionary, they declined where they had been really strong lately. So this is kind of showing a little bit of a shift in the market. The Bank of Canada came out and surprised the markets by raising their rates 25 basis points. Now they are at 4.75%. On a short-term basis, we still have the same list overall. The Stochk RSI, the Williams Percent R, the CCI 14 and 20. Our stochastics, the short-term boom indicator, which is starting to come back down now, as well as the CMB composite index. On an intermediate term basis, the other indications that we have been seeing are now gone. We just have the Sean trend meter, and even it is declining. The dollar was down and interest rates were up. We still have our yield curves that remain inverted. Sentiment is now getting extreme positive. We've ticked up into that 75 area where we had been at 74. Our trend is still positive, but the green line is still coming down overall, but the ADX is still above its moving average, and they are both above 20, so we default to the positive trend. I've still kept our bias at mixed to positive with a slight down day, and we've been really chopping sideways with the S&P, and I've kept our momentum at mixed to positive. We are positive overall, but until we get above that 4,300 level, it's going to be pretty difficult for the market to maintain this positive stance. What are the economic reports that came out? We had the weekly MBA mortgage applications index. Overall, it was down 1.4%. Purchase applications were down 2%, and refinancing applications were down 1%. The trade deficit got a little bit wider to $74.6 billion, but less than the $75.3 billion they had expected, and it's up from last time where it was at $60.6 billion. Consumer credit continues to advance, up $23 billion and more than the $21 billion they had expected, and also greater than the $22.9 billion that we saw last time. Going through some Isabel net charts, we can see in this chart the cumulative flows that are going into the tech sector. It's going parabolic right now. It's just going right up as people chase what's already happened. That could produce some kind of a short-term top in the NASDAQ and NASDAQ 100, especially since they have a lot of tech stocks. People tend to arrive late to the party after something has already happened. We'll see if that turns into some kind of an extreme reading that shifts the market or not. Right now, it has not. Then we look at the sentiment overall, where we had been pretty extreme negative in the latter part of 2022. We're showing some improvement now, but not getting an extreme reading based on this chart. Then we look at the risk appetite indicator, where it's going slightly above zero. So people are just slowly but surely willing to take on more risk. This is the path that Goldman Sachs has taken over the last year or so, trying to decide if we're in fact going to go into a recession. Back in April of 2022, they said that they were at a 15% chance that we would go into a recession. In June of 2022, that was raised to 30%. Then in October, it was up to 35%. Then earlier this year in February, they lowered it down to 25%. Then in March, back up to 35%. And in June, they're back down to 25%. So this changes pretty quickly. Then I showed some of these charts over the last few videos. I just wanted to compare them. It's looking more positive when we're looking at the S&P 500. We're seeing more net long futures contracts, and it's not necessarily a real extreme reading right now. We compare that to the NASDAQ 100, also showing some improvement. Maybe getting a little toppy in the short term, but it is showing some improvement. And then today we look at the small caps. You see how they've been really underperforming? Well, now that seems to be the latest rage over the last couple of days. We had that really huge run up on Friday. Then we saw a real downtick on Monday. But then on Tuesday and Wednesday, we've seen the small caps really starting to do well. That's not really reflected in this chart. So this is kind of the one more area that the market really needs to improve in if we're going to get set to go higher. Then looking at the euro against the dollar on a monthly chart, and I usually cover this in the intermarket analysis video. I'm not going to really go through all of this. We just want to be aware of where is the euro in relation to the dollar. When the dollar is going down, that tends to give support for stocks. When the dollar is going up, that tends to add some headwinds. Lately, the euro's been going back up, but we're seeing some recent weakness, which could continue to help the dollar improve, which might provide some headwinds for stocks. Then looking at what are people freaked out about the most right now, it's commercial real estate. And we're hearing about that in some of the podcasts that I listen to. You're seeing a real high vacancy rate in businesses in major cities. And so that's what people are really concerned about. The next thing they're worried about is the shadow banking system. And I put a little definition over here on the right. These include investment banks such as Goldman Sachs or Morgan Stanley, different mortgage lenders, money market funds, insurance, reinsurance companies. I think this also includes credit unions. These are different institutions that people put their money into that are outside of the normal banking system, and then the other risks that people are deciding to fixate on. This chart just shows how the job cuts are starting to increase a little bit. We really spiked up, have come back down, but we're trying to keep a really close eye on the employment situation because that is still quite strong and it still justifies the Fed raising interest rates. It also justifies us not necessarily going into a recession. The next chart just says the S&P is only up 0.5% in 2023. If you take out the top 10 stocks, the orange line are the top 10 stocks. The blue line is what we would have done if you took those stocks out of the mix. The other 490 stocks that make up the S&P 500. Keeping an eye on the Fed, we're dropping a little bit here. There's a 66.7% chance that they will leave rates unchanged. Then over on the right, it's increasing a little bit with those that think there will be a 25 basis point hike. Now we still have a number of days to go before the meeting, but we just want to keep an eye on this. This is how it's changed. We're right now the dark blue area. That's where we're at. The dark blue is where we're at right now. Then we go back one day to look at that. Then we go back 1 week. And then a month ago, we were actually looking at more probability that the Fed would leave rates unchanged. And then we see over here on the right-hand side, there's a bit of an increase with those that think that the Fed is going to raise rates 25 basis points. Getting into our charts and analysis. Here's the intraday chart. We did have a higher open. We got above R1. We never made it up to R2. But this set the high for the day. Then we fell back. We came down to the unchanged level, went negative. Did find support for a little while along the daily pivot, eventually broke down below that, came down to S1, fell below that a little bit, and then we just chopped around S1 for the rest of the day. We closed just slightly above S1. Here's the 10-minute intraday chart of the SPY. The initial overnight session was a little bit positive. Then we fell back in the pre-market session, but then prices were starting to claw back. Then we opened with the stock market, saw some weakness, and now we're still going pretty much flat in the initial overnight session. Now we're starting to see where growth is underperforming value. The red line's on top, the blue line is going down. When we look at this on a closing basis, growth was down 0.82% where value was up. It also underperformed for the mid caps as well as the small caps, even though the mid caps and small caps are experiencing a little bit of love right now. We look at the growth to value ratio where the whole day it had been trailing off. It ticked up a little bit at the end. That's something that we want to keep an eye on to see if the situation shifts. When this shifted from value being preferred over growth, that was at the end of 2021 and into the beginning of 2022. So we want to watch these things. Looking at sentiment, still suggesting that there's not a lot of fear. The line chart was pretty much flat as well as the bar chart, and the VIX just continues to fall. The VIX of the VIX is also chopping more or less sideways and is slightly down on the line chart. This is another interesting thing that I've been trying to bring up. This is a long-term simple moving average, 253 periods, which are the number of actual trading days in a year. It's starting to roll over. Now you have to read this opposite. When this was going up, that's when the market was running into trouble. If it's going to really turn and start to go down, that could give the market some good support. Looking at another fear gauge that we follow, we ticked up just slightly with this fear gauge, and we actually ticked down a little bit with our other fear gauge. We still are maintaining a risk on posture, even though the ratio did decline slightly. Our advanced decline line. This is showing some improvement based on price, and we're seeing much improvement based on volume. We're not seeing a short-term negative divergence right now. Longer term, we did have this negative divergence, but the further we get away from that and the more this improves, the more irrelevant this negative divergence becomes. We're seeing some improvement with the new highs. You see where we spiked up a little bit, even with a down day? That could mean that the other 490 stocks in the S&P 500 are starting to do better. We haven't quite turned positive yet with our 5 period, but we're starting to turn back up with the 10 period. The advanced decline ratio is still above 0 and advancing. That's positive. We're still above the moving average with accumulation distribution, even though it did decline. And we're seeing some improvement with our cumulative advanced decline line. It's starting to spike up and get above this downward slope that we had been in. And we're also seeing an improvement with the regular NYSE advanced decline line. And we're also getting back above this upward sloping trend line with the NYSE advanced decline line. We still have this negative divergence longer term when we look at common stock based on price as well as volume. Again, if we show some improvement here on both price and volume, the more irrelevant this negative divergence may become. Our broad measure, the NYSE, is back above its moving average, as is the S&P, the mid caps, and the small caps. This is what I mean when I'm saying the broader market is showing some improvement. Our trend, we're positive, we're above the moving average, we're above 20 with both, but the green line is coming down, although it is on top. Our shorter term trend analysis shows pretty much the same thing. We're going up above 20 with the trend, the green line's on top, but it is declining. Volume was above average in Wednesday's session, but overall we've been seeing a decline in volume. Our short-term analysis, here's the daily chart where we've been chopping sideways with the S&P itself. On the bottom, you can see where we were above the moving average line. We're showing some improvement with the 20, 50, and 200-day exponential moving average study. The Stochk RSI, even though it's coming down, is still extreme positive, as is the Williams percent R, the CCI 14, and the CCI 20. So we've not worked off this short-term overbought condition. This is also confirmed by looking at our stochastics. Short-term, we're coming down, but still extreme, turning down in the intermediate term, starting to go flat in the long term. The force index declined a little bit, but is still positive. The boom indicator, after getting above this blue line, has now started to fall back down. We're showing a bit of improvement with the 50 and 200-day moving averages. The CMB composite is still extreme positive, although it is declining. And we're coming back down to the double and triple exponential moving averages. We're still far away from the regular moving averages, the simple moving average and the exponential moving average, but we're coming back down to these lines. Will this provide some support? Intermediate term, where the balance of power, even though it's declining, is still above the dashed line. The go, no-go system remains positive. The TTM squeeze is also showing strength. We're coming back down into the second standard deviation level here on this chart. So that means we've worn off a little bit of that extended condition. And the Bollinger Band's starting to come back down inside of the upper Bollinger Band. That's confirmed by the percent B indicator, where it's no longer extreme positive. PPO studies, long-term, intermediate term, doing okay. Turning down with the short term, but still above zero. With the S&P, McClellan oscillator, above zero and advancing. The NYSE, McClellan oscillator, above zero and advancing. The summation index turning back up and getting slightly above zero based on price and showing more improvement based on volume. The summation index, which is a broader measure that we look at, turning back up based on price and volume, but still has a ways to go. Swenlin trading oscillator, above zero and advancing based on price and volume. The PMO is still positive overall. We're finally turning back up based on price, and we've already turned up based on volume. The PMO study, looking more positive with the PMOs that are rising and not quite extreme, showing some improvement with the buy signals and turning back up with the PMOs that are above zero. The parabolic SAR remains positive with the dots underneath. The Elder Impulse system for the S&P has switched to neutral. The slope indicator is advancing and is positive, as is the MACD. We look at all of our different oscillators. They're pretty much all turning positive. The tricks and the KST, which are our longer term oscillators, are starting to go up. The Sean trend meter, it is declining, but it's still extreme positive. We're seeing some improvement with the BPI above 50 and advancing, but we're still seeing this longer term negative divergence. If we can break out above this kind of sloping down trend line, that would really help improve this chart. The NYSE bullish percent index is just barely above 50, so that suggests broader participation and some improvement. The Chaikin money flow did decline just a little bit, but is still positive. The Chaikin oscillator is turning down, but still above zero. The ultimate oscillator is declining, but above 50. The money flow also declining and above 50. The vortex continues to be positive. On balance volume, even though we declined, we're still above the moving average. And then we're seeing some improvement here with the stocks that are above their 200-day moving average that make up the S&P. We're starting to show a little bit of a breakout here, and we're seeing that same thing when we look at the 50-period moving averages. The Kopit curve continues on a buy signal, and the Pring bottom fisher has also generated a buy signal. Our Fibonacci lines, we're still above this 4170 level. If we fall, will that provide support? We're also in this red area that is providing overhead resistance. What we're going to need to do first is get above 4,300 and then exceed the August high from last year. That would really turn things a lot more positive. Not really showing too much here with our short-term fib levels. We have the previous high set as overhead resistance, and we're quite a ways away from the 4123 level if we start to fall. Longer term, we have overhead resistance at 4313, and we also have support at the 4156 level. Longer term, if we start to fall, we'll be watching the 4214 level. And then we're outside the upper line on this downtrend channel. The longer we can stay above this, the more positive it will become. Looking at our different charts, the Heikin Ashi remains positive, as does the Kegi, the Renko, and the 3-line break. Looking at different indexes, even though the equal weight has been underperforming the S&P, we're seeing this really start to show some improvement. We're still seeing that longer-term negative divergence between the Dow and the transports, but the transports are showing some improvement here. We're seeing a shorter-term negative divergence with the utilities, but we're also seeing some improvement. The transports, even though they're underperforming the Dow, are showing some more improvement. The equal weight index compared to the S&P, after the equal weight has really been outperforming, we're seeing this ratio coming down, suggesting broader participation. The Dow is above both its 50 and 200-day moving averages, pretty much chopping sideways right now. If it starts to go up, we'll be watching this R1 level. The diamonds still remain positive. The NASDAQ, after coming up almost to this R1 level, has seen some weakness after going up so strong for a number of days. And we did fall back below this 13,152 level, which is a 50% retracement. It's really hard to see on this chart, but we're just seeing a little bit of a turn up with our cumulative new highs minus the new lows. And when we take just a raw score, we still are positive when we subtract the new lows from the new highs. The NASDAQ 100 also, after really going up, is seeing some profit taking. The Qs remain at neutral, and we drop down below the 61.8% Fibonacci retracement level. Is this just a short-term pullback? Are we getting ready to see some kind of a reversal? The BPI for the NASDAQ 100 did decline just slightly. Small caps, this is where we're just seeing, boom, going up. Was able to get back above its 50 and 200-day moving average and close above this R2 level. And the RSI starting to get a little extreme with the Russell 2000 index. We're coming back up to this support level that we were watching a number of months ago. Will this provide overhead resistance? And then the MACD is also positive in showing some strength. The small caps, even though they're underperforming the S&P, continue to show some improvement. And the Elder Impulse system for the small caps is positive. And small cap growth is starting to underperform small cap value. Is this a short-term phenomenon, or are we going to see a real shift in this overall ratio? We'll keep watching this. The mid caps also going up nice and strong, potentially coming back to a golden cross with the moving averages, closed above R2. The Elder Impulse system for the mid caps is positive. And even though the overall index has been declining, growth has been outperforming value, but we're seeing some weakness, trying to determine, is this a shift or just a short-term thing that is happening? Keeping an eye on the financial sector, it was up, but still in an overall downtrend. The financials continue to underperform the S&P, but showing some improvement. And the regional banking ETF is also showing improvement, but still in an overall downtrend. Bonds, we were up based on yield and down based on price, and we've come down to the 200-day moving average. Will this provide support? The MACD continues to be negative, and we're below 50 and declining with the RSI. That's when you're looking at bonds based on price. Longer term, when we compare the S&P to the longer term bond ETF, we're still showing a drop-off in the longer term relationship. Shorter term, it has been showing a little bit of improvement, and the spread between the two continues to be quite wide. What we want to see for a good, healthy environment is this longer-term relationship to go back above this dashed line, and then possibly to see the 10 period start to come back down, which would then take the spread closer down to this blue line. That would suggest that things are stronger right now. When we look at shorter-term bonds and compare them to the S&P, the bonds are really underperforming. Taken another way, the S&P is outperforming, and the more it's going up on the S&P chart, the more it looks like we might have a soft landing. When we look at the broad market compared to shorter-term bonds, we are really seeing the broad market outperforming bond prices, and riskier bonds are seeing some improvement when compared to more conservative bonds. Then we compare cash to the 3-month bond. This is a concern, and we've been watching this for a few days. We were starting to break down in this overall relationship. Now we're starting to go back up, which means there's uncertainty. We haven't generated a golden cross yet, but we're not seeing this ratio really continue to fall, which is what we had been seeing before. Then looking at shorter-term bonds and comparing them with longer-term bonds, we're just at the upper side of the rainbow, and this ratio is starting to go back up. When this ratio is going down, that means that the market thinks the Fed is finished raising interest rates. Well, they're not convinced of that right now, so this ratio is going back up. Then looking at longer-term bonds and comparing them with shorter-term bonds, we're seeing this ratio also starting to go back down. If the market thought we were finished raising interest rates, this ratio would be going up. And then we're keeping an eye on this too. Even though the 3-month yield did come down, it's still above where we were at before the great financial crisis. So we're wondering, is this some kind of a warning sign? Our long-term analysis. This could also be positive longer term. The special K is turning back up, but it hasn't quite crossed the red line yet. If it does, that could be positive. You notice at the beginning of 2022 where we crossed below and then we've been underneath it this whole time? Well, that's why 2022 ended up being a very challenging year. If this can cross back above the red line and start to go up, that could really put a positive backdrop to the market. Then looking at our longer-term moving average study, we're crossing above the blue line on the 150 as well as the 200. So this is longer term, looking more positive. An update of our possible positive scenarios. We continue to see some improvement when we look at the 19-day exponential moving average of the advanced decline ratio. We're above zero and advancing based on price as well as volume. We're seeing a little bit of weakness now, but still overall strength when we compare the Qs to the S&P. Discretionary, it turned down just slightly, but has been showing some improvement. And large cap growth is now turning down when compared to large cap value. When we compare the growth to value ratios, the large caps are turning down, the mid caps have dropped below the moving average, and the small caps are also dropping. Haven't shown these charts in a while. These are the number of stocks inside the S&P that are above their 50-period moving average. We are showing some improvement here. We're above 50 now, where we had been quite lower. When we look at the mid caps, we are also seeing some real improvement. And with the small caps, we continue to see some improvement. So under the surface, there are encouraging signs. We just need to see some more follow through, and then we need the large caps to come back in, take over, and then really push the market higher. The S&P to utilities ratio ticked down just slightly, but has been performing well lately. And this is also encouraging. When we take a 5-period moving average of the highs minus the lows for the Amex, NASDAQ, and NYSE, we still are above zero. And we're seeing a little bit of improvement with the red line. It's turning back up when we look at the 50-period exponential moving average of the new highs minus the new lows, because the black line, our indicator, remains above zero. But we're seeing some weakness when we compare S&P 500 growth to value, where we had seen some real strength going back to February. Then we were chopping sideways. Now we're starting to come down. Is this going to continue to fall, or are we going to be able to turn and go back up? 2-year Treasury yield not really helping us now. We spiked up, came down. Now it's starting to come back up. But this continues to show some improvement with the staples really underperforming the S&P. So this ratio is going down. That oftentimes gives really good support to the market. But I want to warn you, when we spiked and started going down, the S&P had already put in a pretty good run to the upside. We've been chopping sideways. If this ratio continues to fall, will that provide some support for the S&P to go higher? So what's our outlook for Thursday? We still have some earnings to deal with. The technicals are positive, but the negatives that we've been seeing and the negative divergences, they are showing some improvement. We have weekly jobless claims coming out as well as wholesale inventories. And then we're really fixated right now on inflation and interest rates as the market tries to figure out what is the Fed going to do. Here is the weekly look at the economic calendar, where we just have a couple of reports coming out on Thursday, and there will be no reports on Friday. For the Stock Traders Almanac for June 8th, we tend to be positive with the Dow and S&P, where we're neutral to positive with the NASDAQ. We're on the 6th trading day of the month. We're looking historically during a pre-election year, the green line, it is starting to come down a bit, where the NASDAQ tends to perform well into the mid part of July. So what are our scenarios? Can't really go with the down one now. We're still quite positive. We're going with the up scenario, but the big warning right now is, can we get above 4,300 and then close above 4,300? So we're not really going with the sideways trend for right now. The ADX is showing that we are in a trend. Warning signs. The new highs and new lows in the S&P, they're not really expanding, but we did see some improvement on Wednesday. The BPIs are diverging, but we crossed back above 50 with the BPI. There are a lot of negative divergences and signs of weakness, but they are starting to show some improvement. The VIX is still showing that there's not a lot of fear. The cumulative new highs and new lows on the NASDAQ continue to show weakness, but we saw just a little bit of a tick up in Wednesday's session. The 3-month yield is still above the pre-Great Financial Crisis level, and we're wondering, is that a warning sign? Small caps and mid caps, they've generated recent death crosses, but we're seeing some real strength as of late. And then earnings season, that can be either positive or negative. Positive signs. We still have seasonality and setups that remain in the background. The Copic curve and the Pring bottom fisher, they have generated buy signals. The S&P is still above that downtrend channel upper line. We're still in a risk-on posture. Lower price levels may provide some kind of support, or that could be a Fibonacci level or a moving average. The S&P continues to outperform utilities, even though it ticked down slightly on Wednesday. The NASDAQ and NASDAQ 100, even though they're pulling back, they're still breaking out from where they were before. And the staples are underperforming the S&P 500, which could give some really good support. Then small and mid-cap growth is showing strength, but we're seeing this weakness, and we'll be watching this to see if it's shifting over to a more negative stance. Our conclusion, the S&P, it's positive, and a lot of the negatives that we've been complaining about are showing some improvement. In the short term, we're still overbought. Intermediate term, we're slightly overbought. We still have the Sean trend meter that's extreme, but even it is declining. Long term, we're still positive as long as we're above the 200-day simple moving average. Thank you. I hope you found this helpful. I hope you have a really good day, and I will talk to you in the next video.